Absci Corp, ticker ABSI, just reported their Q2 2026 earnings, and while they completely missed consensus on both the top and bottom lines.
Yeah, a really rough quarter on paper.
Right. Earnings per share came in at negative 21 cents. That actually misses consensus estimates of negative 19 cents by 2 cents.
Yeah.
But the top line miss is the real shocker here.
Oh, the revenue drop is staggering.
They reported a mere $318,000 in revenue. That is down 46.37% year over year, against expectations that were ranging from $0.92 million all the way up to $1.01 million.
So they totally whiffed on the top line.
Completely. Now, management did guide that their current cash reserves will fund operations into the second half of 2028, but the stock reaction was brutal. Shares tumbled over 17% in after hours, trading to around 7.77, which totally wiped out a 4.4% gain from the regular session.
Look, for a traditional company like someone selling software or consumer goods, an almost 50% drop in quarterly revenue is a massive red flag. But you have to remember that ABSI is a clinical stage biotech company, and they're using generative AI for drug discovery. In this very specific corner of the market, a single quarterly revenue miss, it really isn't the whole story.
Right. The rules are a bit different here.
Exactly. The after-hours trading bots, they just trigger a sell-off based on that top-line algorithm. But our goal in this deep dive is to look into the actual SEC filings and clinical data to see what those algorithms might be mispricing.
Because there is a glaring paradox on their balance sheet right now.
Oh, a massive one. You've got a company generating just over $300,000 in a single quarter, yet it somehow maintains a $1.58 billion market cap.
Yeah, the financials under the hood are stark, and they really highlight that disconnect. Let's look at the burn rate. The net loss for the quarter actually widened to $33.2 million.
Which is up from $30.6 million a year ago.
Right, and looking at the first half of the year, total operating expenses climbed to $65.5 million. A huge driver of that is R&D, which jumped to $22.6 million for the quarter, up from $20.5 million.
And then SG&A went up too, right?
Yeah, selling, general, and administrative expenses rose to $9.2 million, heavily driven by stock-based compensation to retain talent. So expenses are climbing, and revenue basically dropped to zero.
But, and this is where the balance sheet gets fascinating, look at the cash lifeline.
Right.
If you look at their accumulated deficit, it sits at a staggering $687.6 million. But they closed out Q2 with an enormous $201.1 million in cash, cash equivalents, and marketable securities.
Wait, that's actually an increase from last quarter, isn't it?
Yep, it's a $75.4 million increase from where their war chest was at the end of Q1. So they're burning cash on operations, but their overall bank account got significantly larger.
I genuinely don't understand the mechanics of this, and I think this is where retail investors get incredibly frustrated.
Yeah, the math feels backwards.
Exactly. How do you make $318,000 in a quarter? Which is literally less revenue than a successful local bakery. Miss all your targets and somehow add over $75 million to the bank account. I mean, why are institutional investors handing them a blank check?
Well, it's a massive check, but it is definitely not blank. To understand how a biotech company can have near zero revenue but increase in cash, you have to look at how they actually get paid.
Okay, so how does it work?
Think of biotech revenue, especially in the partnership phase, as being exactly like freelance pay. It is incredibly lumpy.
Right, you aren't getting a steady biweekly paycheck.
Exactly. You get paid strictly when you deliver on major project milestones. So if an AI design phase for a big pharma partner takes a month longer than expected, that milestone payment just slips from June into July.
Oh, I see. Suddenly, Q2 revenue looks completely dead.
Right, but the fundamental health of the project hasn't changed at all.
So the revenue drop isn't necessarily a lost client. It is just a delayed invoice on a massive project.
Basically, yeah.
But a delayed invoice doesn't explain an extra $75 million in cash just magically appearing.
No, it doesn't. That cash influx comes entirely from financing moves made outside of their core quarterly operations. In June 2026, ABSI executed a $100 million public equity offering.
Okay, that makes sense.
And out of that $100 million, $40 million came as a direct strategic equity investment from the pharmaceutical giant Eli Lilly.
Wow. When a company the size of Eli Lilly takes a $40 million direct equity stake in your platform, that sends a very specific signal to the rest of the market.
It is the ultimate validation. I mean, Eli Lilly has one of the largest most sophisticated internal R&D engines on the planet, they aren't handing over $40 million to bolster Absci's Q2 revenue.
Right, it's not a charity donation.
Exactly. They're taking an equity stake because they see something in Absci's generative AI platform that their own labs cannot replicate efficiently. And that specific influx of capital, which brought the net proceeds from the offering to $93.6 million, is what extended Absci's runway into the second half of 2028. It creates a massive buffer against these short-term, milestone-driven revenue dips.
Okay, so the cash runway is secured for the next 2 years. But going back to that rising R&D spend, $22.6 million in a single quarter is still a lot of money to be burning.
It's a ton of cash.
Right. So if they're an AI software platform doing basically freelance design work for bigger pharma companies, why is their internal research and development costs skyrocketing?
Well, that rising R&D spend reveals a huge fundamental shift in their corporate strategy. Absci is aggressively pivoting away from just being a service provider for other pharma companies.
So they aren't just designing molecules and handing them off anymore.
No, they're using their AI engine to develop their own internal clinical pipeline. And the absolute crown jewel of that internal push right now is a program called ABS 201.
Ah, right.
The fresh capital injection is heavily concentrated on advancing this specific asset.
Yeah, I noticed the heavy focus on ABS 201 in the management commentary. This is their AI-designed anti-prolactin receptor antibody, and they are developing it for pattern hair loss, which is medically known as androgenetic alopecia.
Yep, that's one.
During the earnings call, CEO Sean McClain gave a crucial update on their Phase 1 trial, which they call the headline trial. They announced positive interim data. But I want to understand why they chose hair loss as their flagship internal drug.
They chose it because of the underlying biology and the massive commercial void that currently exists.
What do you mean?
Well, to understand why investors care about this interim data, we have to look at the clinical specifics. The blinded interim data showed a highly favorable safety and tolerability profile.
Right, which for a cosmetic dermatology drug is paramount.
Exactly. If a drug cures hair loss but damages your liver, it's dead on arrival. Nobody will take it. But the critical data point management emphasized was the pharmacokinetic profile.
Let's translate that for a second. Pharmacokinetics is essentially just a fancy medical term for how the body absorbs, moves, and ultimately breaks down a drug over time, right?
That's right. And the specific pharmacokinetic metric Absci highlighted was an estimated half-life of at least 65 days for ABS 201.
Okay, here is where this gets completely wild to me from a consumer perspective. Right now, preventing hair loss means taking a pill every single day or rubbing a greasy topical foam into your scalp twice a day, literally for the rest of your natural life.
And compliance is absolutely abysmal because it is tedious and messy.
Exactly. But with the 65-day half-life, the drug stays active in the body for months. Management is stating this supports an incredibly infrequent dosing regimen. We are talking about maybe 2 or 3 injections over an entire 6-month period.
Think about the commercial disruption there.
Yeah.
What Absci is proposing is turning a lifelong daily chore into something you do as infrequently as getting your teeth cleaned.
That is a massive shift.
It really is.
Yeah.
You visit the dermatologist twice a year for a quick, targeted injection, and you're done. That paradigm shift for patient convenience directly translates to market penetration.
Right, because people will actually stick with the treatment.
Exactly. They are attempting to completely upend a multi-billion-dollar hair loss market with a highly targeted antibody. That is the commercial thesis Eli Lilly and the institutional investors are betting on.
And management provided a very clear, concrete timeline for investors to watch to see if this thesis actually works in humans.
Yeah, the upcoming catalysts.
Right. They are expecting a 13-week readout in the second half of 2026. This is huge because it won't just be safety data anymore. This readout will cover actual efficacy metrics.
So we'll see if it actually grows hair.
Exactly. They are going to be measuring target area, hair count, hair width, and hair darkening. Following that, the full 26-week proof of concept data is expected to land in early 2027.
But the strategy with ABS 201 doesn't stop at the scalp. Management was very clear about a secondary focus for this exact same antibody. They are planning to initiate a Phase 2 trial for ABS 201 in endometriosis, starting in the fourth quarter of 2026.
Okay, start right there. Hair loss and endometriosis. From a biological standpoint, those seem miles apart. I mean, how does a single drug address a cosmetic scalp condition and a deeply painful reproductive tissue disorder?
It all comes down to the mechanism of action. Think of the prolactin receptor, like a very specific type of electrical outlet in the body.
Okay, I'm following.
In the scalp, when certain hormones plug into that outlet, it turns off the hair growth machine, causing the hair follicle miniaturization you see in alopecia.
Right.
But in the pelvic region, plugging into that exact same type of outlet triggers severe inflammatory pain pathways associated with endometriosis. So Absci's generative AI basically designed a perfectly shaped, highly durable plug to block that specific outlet all over the body.
That is fascinating. So by pushing the exact same drug into a phase 2 trial for a completely different, high unmet need medical condition, they aren't just trying to cure endometriosis.
No, they're proving a point about their technology.
Right. It shows that their AI didn't just stumble onto a lucky compound for baldness. It engineered a highly specific, versatile tool that can be applied to multiple, entirely different therapeutic markets.
It proves the platform is repeatable. And that brings us directly to how Wall Street is digesting all of this data, which is perhaps the most jarring part of this entire analysis.
Yeah, because we mentioned the stock had a brutal after-hour sell-off, dropping over 17% down to the $7.77 range.
But when you look at the analyst consensus across the board, it remains solidly at a moderate buy to strong buy.
The divergence between the current trading price and the institutional price targets is a massive chasm right now. Let's list these aggressive price targets out because they are so far removed from where the retail market just priced this company.
Let's hear them.
Truist Securities maintained their buy rating with a massive $17 price target. That is an 85% upside from current levels. Yeah. H.C. Wainwright is sitting right behind them at $16. Guggenheim maintained their buy rating at $15. And even Morgan Stanley, which is the most conservative firm of the bunch with an equal weight rating, still has a price target of $10.
Which is still over $2 higher than where the stock settled after hours.
Exactly. So we have to ask why this massive disconnect exists.
Hmm.
Why are top-tier analysts modeling 85% upside while the retail market is just dumping the stock?
Well, to understand this, you have to weigh the core risk profile that is causing this friction. The market is currently pricing in a mountain of immediate fear that the analysts are looking past.
It goes right back to that $318,000 revenue miss, doesn't it? The retail market hates uncertainty, and lumpy, milestone-dependent revenue is the absolute definition of uncertainty.
Yeah, that volatility is par for the course in biotech, but what the retail market is really reacting to is that radical shift in Absci's corporate identity.
The shift to internal R&D.
Exactly. Historically, platform companies like this would use their advanced AI to discover a novel drug and then immediately license it out to a massive pharmaceutical partner.
So the big pharma company pays for all the incredibly expensive clinical trials.
Right. And Absci would just sit back and collect a safe, steady royalty with almost zero downside risk.
But they aren't doing that with ABS-201. They are choosing to develop it internally through these phase 1 and phase 2 trials, meaning Absci is the one footing the bill for that $22.6 million a quarter in R&D.
Yes. By choosing to run the clinical trials themselves, they retain vastly more potential upside. If ABS-201 actually works, they own the asset outright rather than just getting a tiny royalty slice.
But it fundamentally increases their immediate cash burn.
Oh, absolutely. And more importantly, it places massive absolute binary risk on the upcoming 2026 and 2027 trial readouts.
Right, because if it fails, there's no backup plan.
Exactly. If that 13-week hair count data comes back later this year and fails to show significant growth, the value of ABS-201 plummets to near zero. And if their flagship drug fails, a huge portion of that $1.58 billion market cap will evaporate instantly.
So you have two completely different timelines clashing. The analysts with their $17 price targets are looking at the math of the AI drug design and assuming a high probability of success in the upcoming human trials.
While the retail market is terrified.
Right. The retail market trading after hours is terrified by the lack of immediate, safe milestone revenue. They're looking at the cash burn and the lack of a safety net while they wait for those trial results.
That is the exact tension playing out in the share price today. The algorithmic market is demanding a steady biweekly paycheck, and Absci has essentially quit their day job to bootstrap a high-risk startup using their savings account.
Well, to be fair, that is a $201 million savings account strongly backed by Eli Lilly.
True, but the clinical risk remains entirely on Absci's shoulders.
It really is a high-stakes waiting game now, entirely dependent on what happens in that 13-week readout. To make sure you don't miss a single beat of the story as the clinical data drops or any of the other massive earnings reports hitting the tape this season, make sure you follow the show. We are here delivering daily, no-nonsense earnings coverage to help you cut through the noise of the market.
And as we wrap up, I want to leave you with a final thought to ponder regarding the valuation of these next-generation AI-native biotechs.
What's that?
For decades, the market has valued biotech companies based on their individual assets. But if a company's true value engine is a generative AI algorithm capable of designing novel antibodies entirely from scratch, should we really be valuing them like traditional firms?
That is the big question.
Think about it this way. Are we currently valuing them like a struggling tailor, desperately waiting to sell a single handmade suit to prove their worth?
Yeah.
Or should we be modeling them entirely differently, like the invention of the sewing machine itself?
Oh, I like that analogy.
Right. Because if the platform works, the value isn't in the one suit they just made. The value is in the fact that the machine can now seamlessly stitch together a million different patterns on demand for any disease.
It brings us right back to that glaring paradox. $318,000 in revenue against a $1.58 billion market cap. Are you evaluating a struggling freelancer sweating over a delayed invoice, or are you looking at the foundational technology that is about to rewrite the entire pharmaceutical industry? That is the $1.5 billion question you have to answer.